Ethereum has been the punching bag of 2025. While Bitcoin has been chopping and Solana stole the limelight with its meme coin Casino, the king of smart contracts has been reduced to a whipping boy. Lagging price action, disappointing ETF flows, and a narrative shift that claims Layer 2s are sucking the life out of the mainnet. If you look at the ETH-BTC ratio, it's a disaster zone. If you look at the sentiment, it's arguably worse than in the depths of the 2022 bear market. But here's the twist. While retail investors are panic selling and calling for a $1,500 ETH, the largest financial institutions in the world are quietly building the entire future of finance on top of it. So, is Ethereum in terminal decline? Or are we looking at the ultimate contrarian buy signal before a 2026 rotation that melts faces? My name is Guy, and you're watching The Coin Bureau. Today, we're diving deep into the data to separate the FUD from the facts when it comes to Ethereum. But before we dig into this on-chain mystery, a quick disclaimer. I am not a financial advisor, and nothing in this video is financial advice. Crypto is risky, and you should always do your own research. But if you want to help us beat the YouTube algorithm, which, let's be honest, hates crypto almost as much as the market hates ETH right now, then prove it by punching that like button. Ready? Okay, let's get into it. So, to understand if Ethereum is dead or just a sleeping giant, we first need to look at the crime scene that was 2025. Because, let's be real, it's been ugly. As of late December 2025, Ethereum is down roughly 12.32% year to date. Compare that to the Nasdaq, which is up 22%. That's a staggering 34 percentage point underperformance against tech stocks. And it only gets worse when you compare ETH to its digital rivals. While ETH has been bleeding, Solana has been eating Ethereum's lunch on DEX volume and mindshare. But the price action tells a story of two halves. Remember the spring of 2025. ETH looked dead in the water, sentiment was in the gutter, and then we had the summer rally. From lows of just over $1,400 in April, ETH ripped over 100% to hit an all-time high of $4,951 in August. Why? Well, the ETF narrative, institutional adoption, and the feeling that ETH was finally catching up to BTC. But as quickly as it came, it went. Since that August peak, we've seen a brutal 40% correction back down to the $2,900 level we see today. So, what exactly happened? Why did the narrative flip so violently? Well, there are three main suspects in this murder mystery. Suspect number one, the L2 parasites. You've probably heard the argument. Layer 2s are vampires sucking the value out of Ethereum. And, logically, when you look at the revenue data, it's hard to argue. Before the Dencun upgrade, Ethereum mainnet was generating $30 million in daily fee revenue. Today, that number has collapsed to roughly $500,000, a 98% drop in revenue. Yikes. Because fees have dropped so low, the burn mechanism, EIP 1559, has basically turned off. Ethereum has flipped from being ultrasound money and deflationary to being inflationary again. Critics like Justin Bonds argue that Layer 2s like Base and Arbitrum are capturing all the execution value, while Ethereum is left holding the bag as a low-revenue settlement layer. Case in point, Coinbase's Base chain. Base generated over $94 million in profit in 2025, but paid only a fraction of that back to Ethereum in blob fees. So, is ETH dead because Layer 2s basically killed it? Well, not so fast. Because while revenue is down, net inflows to Ethereum's Layer 1 were actually $4.2 billion in 2025, the highest of any chain. Investors are still parking their capital on the mainnet for security, even if they are trading on Layer 2s. But that brings us to suspect number two, the ETF disappointment. When Bitcoin ETFs launched, number went up. When the Ethereum ETFs launched, number went down. So why the difference? Well, two words: staking yield. In the real world, if you hold ETH, you can stake it for a 3 to 4% annual yield. But because of the SEC, the US spot ETFs cannot stake their coins. So, if you're an institution, why would you pay a management fee to hold an ETF that loses to inflation, when you could just hold the asset itself and get paid up to 4%? It's a massive opportunity cost. And on top of that, we had the grayscale unlock. Before spot ETFs came along, pretty much the only way institutional and non-crypto native investors could get access to BTC and ETH were via Grayscale's trusts. Once spot ETFs were approved, however, these trusts became largely obsolete, and their fees were way higher than those being offered by ETF issuers. So, just like with Bitcoin, the Grayscale Ethereum Trust, ETH, saw massive outflows, over $5 billion. This created constant sell pressure that the new inflows from the likes of BlackRock and Fidelity just couldn't fully absorb in the short term. And to cap it all off, net assets in ETH ETFs dropped from a peak of $30 billion worth in August to around $18 billion worth by year end. And finally, we have suspect number 3, the DAT collapse. Earlier this year, we saw a massive trend of digital asset treasury companies, or DATs. Companies like BitMine and SharpLink were raising cash to buy ETH, trying to copy the MicroStrategy, since renamed just Strategy, playbook. It worked for a while. But as the ETH price tanked, many of these companies started trading at a discount to their net asset value. Some, like ETHZilla, were even forced to sell ETHs to fund share buybacks. It was a vicious cycle. As the price dropped, DATs were forced to sell, causing the price to drop still further. So, revenue is down, ETFs are bleeding, and corporate buyers are underwater. Game over for Ethereum, right? Well, here is where we need to tune out the FUD and focus instead on the fundamentals. Because if you look away from the price chart and look at what's happening on-chain, you see a completely different picture. Let's call this the institutional paradox. While retail is selling, the biggest players in traditional finance are building. Case in point, BlackRock. BlackRock's Biddle Fund, which tokenizes US Treasuries, has grown to over $2.4 billion in assets. And where does the vast majority of that live? On Ethereum. Why aren't they building on Solana if it's faster? Why aren't they building on Bitcoin? Because Ethereum is still the only chain with the regulatory clarity, the smart contract maturity, and the settlement assurances that a monster like BlackRock requires. And it's not just tokenized treasuries. Look at stablecoins. Ethereum holds approximately 70% of the entire stablecoin market supply, roughly $170 billion. This is the lifeblood of the crypto economy. While Solana is winning on casino chips and meme coin volume, Ethereum is winning on real money settlement. And remember those corporate treasuries? Well, despite the price drop, BitMine, led by Tom Lee, has continued to accumulate. They now hold the world's largest corporate ETH treasury, valued at around $12 billion. And unlike the ETFs, they're staking it. So, we have a massive disconnect. Price is telling us the network is dying, while adoption is telling us the network is becoming the settlement layer for the global financial system. Usually, when price and fundamentals diverge this much, it creates an opportunity. But for that opportunity to pay off, Ethereum needs a catalyst, a roadmap to fix the sentiment. And the good news is, the 2026 roadmap is stacked. Now, we already had the Pectra upgrade in May 2025, which helped scaling, and the more recent Fusaka upgrade, which improved transaction volumes while lowering fees. But the real game changers are coming in 2026. First up, we have Glamsterdam. Scheduled for the first half of 2026, this upgrade is huge. It introduces something called EPBS, or Enshrined Proposer Builder Separation, which, yes, does sound a bit like Gwyneth Paltrow's next divorce. But, simply put, it makes the network more decentralized and censorship resistant. It also aims to increase throughput towards 10,000 transactions per second by the end of the year. Then, in late 2026, we'll have the Hagota upgrade. This will bring in Verkle trees. Now again, super technical, but the Explain It Like I'm 5 version is this. it makes running a node much, much lighter while solving the state bloat problem that makes blockchains slow and heavy over time. This is the lean Ethereum vision that Vitalik Buterin has been preaching. But arguably the biggest catalyst for 2026 isn't code, it's regulation. Remember the staking yield issue with the spot ETFs? Well, BlackRock officially filed for a staked Ethereum ETF on the 8th of December 2025. With the new political landscape in the US, analysts predict we could see approval by mid-2026. And if that happens, holding the ETH ETF suddenly gives you a 3 to 4% dividend. That changes the maths entirely for pension funds and wealth managers. It turns ETH from a speculative asset into a yield-bearing and productive one. So, let's wrap this all up. Is Ethereum dead? Well, the data simply doesn't support that. You don't have $170 billion in stablecoins and BlackRock building their future on a dead chain. Is it a punching bag? Absolutely. Sentiment is at rock bottom, the L2s are extracting revenue, and Solana is winning the mindshare war for retail attention. But here's the thing about markets. They move in cycles. In 2022, many said Solana was dead at $8. Then it did a 20x. In early 2025, plenty of people were out there reading ETH The Last Rites at $1,500. Then it rallied well over 100% in just a few months. Now we're back just below $3,000, the Fear and Greed Index is at 24, extreme fear, and ETH is once again being written off. The timeline has screamed it's so over many times before, and is doing so once again. But the fundamentals, institutional adoption, tokenization, supply scarcity, are actually stronger today than they were at the all-time highs. The only thing missing is hype. And if we know anything about crypto, it's that hype can return in the blink of an eye. If the staking ETF gets approved, or if the rotation trade kicks in once Bitcoin tops out, then Ethereum could remind everyone why it's still the prince to Bitcoin's king. But what do you folks think? Is ETH a sleeping giant about to wake up in 2026? Or has the layer 2 parasite drained it for good? Let me know in the comments below. And if you enjoyed this deep dive, smash that like button and subscribe for more data-driven crypto content. I'm Guy, this is the Coin Bureau, and I'll see you next time.